Hey everyone, welcome back to BullionIQ, your go-to channel for understanding cryptocurrency, global finance, and how major events can directly affect your money. If you're new here, make sure to subscribe because we cover financial events before the headlines reach mainstream news, giving you an edge in the markets. Today we're talking about something massive, something that could change the way you view your investments and even cryptocurrencies like XRP. Japan has just broken the global financial system, and if you're not paying attention, this could impact your savings, retirement, and portfolio in ways you never imagined. For over 30 years, Japan printed money at near zero interest rates and exported it globally. Trillions of dollars flowed into U.S. treasuries, European debt, and emerging markets. This invisible bid kept stock markets inflated, governments solvent, and interest rates artificially low. But that all just changed. On November 20th, 2025, Japan's 10-year bond yield hit 1.71%, the highest since 2008. This may seem like just a number, but in reality, it signals a potential financial crisis. At 1.7% rates, Japan suddenly has to pay $27 billion more in interest each year. Considering their debt is 263% of GDP, the math that allowed Japan to survive for decades is now impossible. Japanese pension funds are starting to pull $1.1 trillion out of U.S. treasuries because keeping money in America now costs them money after hedging. This is huge because Japan has been the largest foreign buyer of U.S. debt for decades. When they stop buying and start selling, interest rates in the U.S. and other markets won't remain stable. They will spike. Your mortgage rates could increase, corporate borrowing costs could jump, and companies that relied on cheap financing could face defaults. The yen carry trade, which involved borrowing cheap yen to invest in higher yield assets worldwide, is now reversing. Trillions of dollars in borrowed yen funding stocks, crypto, and emerging markets are being unwound, forcing investors, hedge funds, and institutions to cover positions simultaneously. This chain reaction will hit global markets hard. Stock valuations were built for extremely low bond yields. With rates rising, markets could drop dramatically. Emerging market currencies will weaken as Japanese capital is withdrawn. European debt crises could return because Italy, Spain, and other nations lose a major buyer. When the Bank of Japan meets in December, there's even a 50% chance of another rate hike. If they act, this could trigger a massive sell-off. The Fed and other central banks may have very limited options to stabilize global liquidity. Here's where XRP could play a role. Analysts like Claver argue that XRP could act as a liquidity bridge in this scenario. The reverse carry trade creates a massive need for fast, scalable global settlement. XRP, with its near-instant settlement times and ability to bypass traditional correspondent banking, could absorb these flows and prevent a total collapse. It's not about XRP's price alone. It's about liquidity, infrastructure, and readiness. Banks and institutions could use XRP to route funds efficiently, helping stabilize the market when trillions of dollars move back to Japan. I know this sounds intense, but understanding these dynamics is crucial for anyone investing today. Over the next few parts, we will dive deeper into the carry trade, how Japan's rate changes affect global markets, and how XRP could become a key player in preventing financial disaster. This is not just theory, these are the movements happening right now under our noses. Japan has changed the game, and if you're paying attention, there's a chance to position yourself before the system reacts. Grab your coffee, stay focused, and let's break down what could be the most important financial story of the year. The situation unfolding in Japan is not just about local economics. It's about the entire global financial system. For decades, Japan's 0% interest rate policy allowed institutions worldwide to borrow cheap yen, convert it into dollars, euros, or other currencies, and invest in higher-yielding assets. This strategy, known as the yen carry trade, became a cornerstone of global finance. Trillions of dollars were involved, and the system relied on Japan continuing its policy of low rates. But now, with the 10-year bond yield at 1.71% and climbing, that cheap funding is disappearing, and the trade is reversing. Investors must scramble to repay yen-denominated loans, triggering a wave of asset sales across the globe. As Japanese institutions repatriate funds, the first impact will be on bond markets. U.S. treasuries, long considered a safe haven, will face massive selling pressure. The U.S. 10-year yield could jump by 40 basis points, or more purely from these flows. That may seem technical, but for everyday investors, this translates to higher mortgage rates, more expensive loans, and increased costs for refinancing corporate debt. Companies that rely on cheap borrowing, sometimes called zombie companies, could start defaulting en masse. The ripple effects are enormous, reaching everything from stock prices to commodities. Emerging markets, which have benefited from Japanese capital inflows for years, will also face turbulence. Currencies in these countries may collapse, and debt servicing becomes far more difficult. The European debt situation could deteriorate as well, especially in nations like Italy and Spain, which depend heavily on foreign buyers to stabilize their bonds. The consequences of this unwinding will be felt globally, as financial systems that have been artificially supported for decades suddenly face real costs. Hedge funds and institutional investors are particularly exposed. Many have borrowed yen to fund leveraged positions in stocks, crypto, and other high-yield assets. As the yen strengthens and interest rates rise, these positions become riskier and more expensive to maintain. Forced selling accelerates the cycle, creating margin calls, liquidity shortages, and sudden drops in asset prices. This chain reaction can overwhelm even sophisticated investors, as the sheer speed and volume of the unwind create systemic stress. So where does XRP come into this picture? The argument from some analysts is that XRP could function as a global liquidity bridge, helping financial institutions navigate the massive flows of capital without collapsing traditional FX and bond markets. Because XRP settles transactions in just a few seconds and doesn't require the slow correspondent banking system, it could absorb trillions in temporary flows during this crisis. In other words, XRP could act as a buffer, allowing the repatriation of funds to happen more smoothly and preventing a total market breakdown. Even though this might sound like a futuristic scenario, the infrastructure is already partly in place. SBI, Japan's largest fintech institution, owns a stake in Ripple and has been developing XRP liquidity corridors for cross-border payments. The Bank of Japan has been piloting a central bank digital currency, which could integrate with XRP to manage large-scale repatriation of capital. While regulatory clarity and full adoption are not yet finalized, the framework suggests that XRP could be positioned as a solution to systemic risk in a high-stakes environment. This is important for investors because it's not only about cryptocurrency speculation, it's about understanding how the global financial system works and how sudden shifts in one country's policy can create cascading effects worldwide. The reversal of the yen carry trade, the repatriation of trillions in capital, and the resulting market volatility could impact retirement accounts, pensions, and investment portfolios across the globe. Watching XRP and other liquidity solutions could provide early insights into how institutions respond to the crisis. We are essentially at a critical juncture. Japan's actions have set in motion a chain of events that could reshape global markets in a matter of weeks. From U.S. treasuries to emerging market currencies and corporate debt, everything is interconnected. While traditional markets struggle to absorb these changes, digital assets like XRP might emerge as a crucial tool to stabilize flows and manage liquidity. Understanding this context is essential for anyone who wants to make informed decisions about their investments and risk exposure. As the reverse yen carry trade begins to unwind, the pressure is not limited to traditional markets like bonds and equities. It also extends directly to the cryptocurrency market. Trillions of dollars borrowed in yen over decades have been funneled into emerging markets, tech stocks, and digital assets. When these positions unwind, investors are forced to liquidate holdings quickly to cover their loans. That means crypto assets, including Bitcoin, Ethereum, and XRP, are at risk of sudden selling pressure. This isn't just about volatility, it's about systemic risk. The crypto market is much smaller than global bond markets, so even partial unwinds can trigger sharp price swings and liquidity challenges. The math is straightforward but alarming. Around 1.2 trillion in borrowed yen is currently funding global assets, including crypto. As the yen strengthens and interest rates rise, these positions become unprofitable, forcing massive sell-offs. Hedge funds and leveraged traders are the first to feel the pain. Margin calls will force them to liquidate positions, and as one institution sells, it triggers further selling by others. This domino effect creates a feedback loop where liquidity evaporates and prices drop rapidly. For crypto investors, this means that even well-established assets can experience sudden and severe declines. XRP's unique role becomes evident in this context. Unlike Bitcoin or Ethereum, which can face settlement delays due to network congestion or reliance on traditional exchanges, XRP is designed for instant settlement. This makes it a potential liquidity buffer during crises. If trillions are moving back into Japan to repay yen loans, traditional FX markets could collapse under the pressure. XRP can theoretically route these flows more efficiently, acting as a bridge between different currencies and markets. It's not about speculation on price alone, it's about XRP's ability to absorb and manage enormous capital movements in real time. For this to work, certain infrastructure and adoption steps must align. SBI, Japan's leading fintech institution, already holds a stake in Ripple and operates XRP liquidity corridors. The Bank of Japan has been piloting a digital yen, which could integrate with XRP to facilitate massive flows. This combination of XRP and a digital yen could theoretically prevent traditional financial markets from freezing or collapsing during the unwind. While regulatory clarity is still required, the technical capability exists, making XRP a strategic tool rather than just an investment asset. The timing of all this is critical. Analysts suggest that if the Bank of Japan continues to raise rates and if global liquidity flows reverse rapidly, the unwind could accelerate within weeks. Investors need to watch bond yields, currency strength, and institutional behavior closely. Crypto markets often react faster than traditional markets, so XRP and other digital assets could see extreme movement before the broader public even recognizes what is happening. Early observation and understanding of these dynamics could be crucial for informed investment decisions. This scenario also highlights a broader shift in financial infrastructure. For decades, global finance relied on predictable low-cost funding from Japan, the US, and Europe. That era is ending. Digital assets like XRP are emerging as real-world tools to manage systemic risks that traditional institutions cannot handle alone. The reverse carry trade demonstrates the vulnerabilities in the current system and underscores the need for speed, scalability, and liquidity, qualities that XRP provides. Investors should also consider the cascading effects on other asset classes. When leveraged positions unwind, not only do bond and crypto markets react, but equities and commodities do as well. This is a multidimensional risk scenario. A sudden spike in the yen, collapsing foreign assets, and forced liquidation in crypto markets could trigger a global reset in valuations. XRP's infrastructure and speed may help stabilize part of this, but broader market volatility is likely unavoidable. In summary, the reverse yen carry trade is no longer theoretical. Its unwind could stress every financial market, including crypto, in ways that few people are prepared for. XRP is positioned uniquely to serve as a liquidity bridge, potentially mitigating some of the worst effects. Understanding how this system works is essential, not only for crypto investors, but for anyone who wants to comprehend the interconnectedness of modern global finance. We're watching a critical event unfold, and the next few weeks could redefine markets as we know them. The implications of Japan's financial shift, it's important to understand how XRP could actively function in real-world scenarios. The reverse yen carry trade unwind isn't just a theoretical threat, it's a potential tidal wave of capital that could move trillions of dollars back into Japan within weeks. Traditional FX markets and banking systems are simply not built to handle that scale and speed. This is where XRP becomes critical. Because it settles transactions in seconds and bypasses the need for correspondent banks, it could act as a global bridge, routing massive flows efficiently and preventing market freezes. Think about the logistics. Trillions of dollars in foreign assets must be repatriated to cover yen-denominated loans. Investors and institutions cannot dump these assets all at once without triggering catastrophic losses across stocks, bonds, and currencies. If XRP is used as an intermediary, dollars, euros, and other currencies could be converted into XRP and then into yen without the delays and friction of conventional banking systems. This rapid settlement could prevent cascading failures in both the FX and bond markets, providing a much-needed buffer for global liquidity. To make this scenario possible, certain conditions must be met. First, liquidity pools for XRP need to be large and deep enough to absorb and route tens of trillions of dollars without causing massive price spikes. Analysts estimate that to handle $10 trillion in flows over a 30-day period, XRP would need to be turned over multiple times daily, requiring both infrastructure and adoption at a massive scale. Institutions like SBI are already developing corridors for XRP, and the Bank of Japan has been piloting a digital yen, which could integrate seamlessly with XRP for settlement purposes. While regulatory clarity is still a factor, the building blocks are in place. The use of XRP in this context isn't about speculation on price alone, it's about functionality. If trillions of dollars are moving globally, the asset used to facilitate that movement must be stable, scalable, and fast. XRP provides these qualities in ways that traditional banking systems cannot. In essence, XRP becomes part of the financial plumbing that ensures the global system doesn't freeze under pressure. This is why some analysts are so bullish on its potential during major systemic events. Another critical factor is timing. The Bank of Japan's decisions on interest rates will directly influence how quickly the reverse carry trade unwinds. If rates rise faster than expected, institutions will be forced to repatriate capital quickly, increasing the demand for any liquidity solution, including XRP. Conversely, delays or slow rate increases could stretch the process over months, giving markets more time to adjust, but still creating substantial volatility. Understanding these timelines is essential for investors who want to anticipate XRP's role in stabilizing flows. The broader implication is that the financial world is entering a new era where digital assets are not just optional. They are necessary. Traditional systems have limitations, particularly under extreme stress. XRP offers a solution to these limitations, providing speed, transparency, and scalability. Institutions that adopt XRP as a liquidity buffer could navigate the reverse carry trade unwind with far less risk than those relying solely on conventional mechanisms. It's also worth noting that the infrastructure for XRP adoption is already growing. RippleNet and AMM systems allow institutions to create liquidity corridors, and strategic partnerships with major Japanese banks increase the probability of real-world integration. If this system is operational when the unwind occurs, it could reduce chaos in markets and provide a controlled mechanism for global capital flows. While nothing is guaranteed, the potential for XRP to act as a stabilizing force in a high-stakes scenario is substantial. In short, the reverse carry trade unwind represents both a risk and an opportunity. It exposes vulnerabilities in global finance, but also highlights the need for innovative solutions like XRP. Investors who understand the mechanics of these flows and the role digital assets can play may have a significant advantage as the events unfold. The coming weeks could demonstrate the first large-scale use case for XRP as a real-world liquidity bridge, not just a speculative cryptocurrency. Now, let's dive into what all of this could mean for XRP's price and its position in the global financial system. Remember, this isn't just about speculation, it's about real-world usage. If trillions of dollars are moving to repay yen loans and XRP is used as a liquidity bridge, the demand for XRP would spike dramatically. Analysts estimate that to handle 10 trillion in flows over 30 days, XRP would need massive liquidity pools and a high turnover. The sheer volume would naturally create upward pressure on its price, potentially sending it to levels far beyond what we've seen in typical crypto market cycles. But it's crucial to understand that price alone is not the goal. It's the liquidity and infrastructure that matter most. The mechanics are fascinating. For XRP to effectively route these massive flows, institutions would need to integrate it into their FX corridors and settlements. This means dollars, euros, and other currencies would be converted into XRP, moved quickly across borders, and then converted into yen. Each of these steps creates a demand shock, particularly if trillions of dollars are involved. When supply cannot immediately meet the demand, XRP's price will respond. This is why analysts project that a real-world usage scenario like this could require XRP to be in the hundreds of dollars per token if it's going to serve as a global liquidity solution. Again, this isn't hype. It's math, liquidity, and adoption combined. Timing will play a critical role in these price dynamics. The unwind of the yen carry trade is not a slow process. Once institutions realize that maintaining foreign positions is too costly due to rising Japanese interest rates, they'll begin liquidating assets to cover their loans. This triggers a chain reaction across equities, bonds, commodities, and crypto markets. XRP's role in this process could cause short-term volatility, but the long-term trend would reflect its function as a liquidity bridge. The more XRP is used in these real-world settlements, the more its value aligns with its utility. Another important factor is the supply of XRP. While the total supply is finite, liquidity must be incentivized and accessible to institutions. XRP held in escrow and released gradually is part of the plan, but to absorb trillions in global flows, institutions will likely need to secure large quantities of XRP and deploy it through active liquidity pools. This could create temporary scarcity, amplifying price movements during the unwind. Essentially, XRP's infrastructure is designed to expand and contract with demand, which is exactly what would be needed in this scenario. We also need to consider the broader adoption ecosystem. SBI, RippleNet, and other institutions are not acting alone. Banks across Asia, Europe, and potentially the US could participate if XRP proves effective at routing liquidity. The more participants, the more robust the network becomes, and the more scalable XRP's solution is. If global banks trust XRP to manage this flow, it could mark the beginning of a new era where digital assets are integral to financial infrastructure rather than speculative instruments. The risks are real, however. Regulatory clarity is still evolving, particularly in major markets. XRP would need approval as a settlement asset and legal recognition for institutional use. Even if infrastructure exists, adoption requires cooperation from multiple stakeholders, including the Bank of Japan, global financial institutions, and regulators. Delays or lack of coordination could reduce XRP's effectiveness and impact price movements. Ultimately, the reverse yen carry trade unwind could redefine the global financial landscape. Traditional systems may struggle under the pressure of trillions of dollars moving rapidly, while XRP offers a technically feasible solution to manage liquidity. Investors who understand these dynamics may have a significant advantage, not because they are speculating on hype, but because they understand real-world financial flows and the unique role XRP could play. If the unwind happens as analysts predict, XRP could see both unprecedented adoption and a significant increase in demand, marking a turning point for crypto and global finance. It's crucial to put everything into perspective and understand the full picture. Japan's financial decisions have triggered a potential global ripple effect, and the reverse yen carry trade unwind could happen at any moment.
Investors and institutions must watch bond yields, currency movements, and central bank decisions closely.
The scenario is high stakes. Trillions of dollars could flow back into Japan, destabilizing global assets, raising interest rates, and creating systemic pressure across equities, bonds, commodities, and crypto markets. In this environment, XRP is uniquely positioned to act as a liquidity bridge and mitigate some of the chaos. But timing, infrastructure, and adoption are key factors that will determine its effectiveness. Let's break down potential triggers. The first and most obvious is interest rate hikes by the Bank of Japan. If rates rise faster than expected, Japanese institutions will be forced to repatriate funds immediately. This sudden demand for yen will put pressure on global FX markets and drive rapid liquidation of foreign assets. Secondly, any geopolitical shock, such as an oil supply disruption or tensions in the Taiwan Strait, could accelerate the need for liquidity and prompt further market instability. Finally, the readiness of XRP infrastructure, including deep liquidity pools, RippleNet adoption, and digital yen integration, will determine whether it can handle these flows efficiently. Timing and coordination are everything. The global financial impact would be massive. U.S. Treasuries could see yields spike, mortgage rates would increase, and corporate debt refinancing costs could rise sharply. Emerging market currencies would face severe pressure, and Europe's debt challenges could resurface. Hedge funds and leveraged traders who borrowed yen to fund positions would face margin calls, causing forced liquidation across multiple markets. Crypto markets, including Bitcoin, Ethereum, and XRP, would experience sharp volatility as capital moves to cover obligations. The speed and scale of this unwind could overwhelm traditional systems, highlighting the need for alternative solutions like XRP. XRP's role is both functional and strategic. Its ability to settle transactions in seconds, bypass the slow correspondent banking system, and scale globally makes it a potential stabilizer in a crisis. If trillions of dollars are routed through XRP during the unwind, the digital asset could absorb liquidity pressures and prevent catastrophic market freezes. Adoption by institutions such as SBI and integration with the Bank of Japan's digital yen pilot are critical steps that could enable XRP to operate as this bridge. While regulatory clarity and large-scale implementation remain challenges, the groundwork is in place for XRP to serve a real-world purpose beyond speculation. For investors, understanding this scenario is about more than predicting price moves. It's about recognizing systemic risk and being prepared for rapid market changes. Diversification, awareness of interest rate trends, and knowledge of global liquidity flows are essential. XRP could offer an additional layer of strategic advantage, acting as a bridge asset in times of extreme stress. Its potential adoption during the unwind could create both opportunities and challenges, depending on infrastructure readiness and market reaction. Finally, we must consider the timing of this event. Analysts suggest that the reverse carry trade unwind could happen within weeks or months, depending on rate hikes and capital flows. XRP futures, ETFs, and liquidity corridors are likely to play a critical role in preparing the system for this scenario. While some steps are already in place, like XRP liquidity pools and digital yen pilots, others, such as regulatory approvals and large-scale adoption, remain to be fully implemented. Investors who understand these dynamics and monitor developments closely will be better positioned to navigate this period of market turbulence. In conclusion, Japan's recent bond yield surge marks a turning point in global finance. The reverse yen carry trade unwind has the potential to stress every corner of the market, from equities and bonds to emerging market currencies and crypto assets. XRP is uniquely positioned to act as a liquidity bridge and help stabilize flows, but success depends on adoption, infrastructure, and coordination between institutions. For anyone interested in global finance or cryptocurrency, this is a critical moment to observe, understand, and prepare for what could be a historic shift in how capital moves around the world. Staying informed and strategic will be essential as these events unfold.